Welcome to the course. We are here to transform your understanding of life insurance into a precise framework that will help you pass your licensing exam with confidence. This content is for informational and entertainment purposes only and does not constitute financial, legal, or tax advice. Always consult a qualified professional before making financial or legal decisions. This course is an unofficial, independently produced study guide and is not affiliated with, endorsed by, or connected to any official state insurance licensing exam board or testing provider. In this opening module, we will demystify the core components of the state licensing exam requirements. Our journey begins by deconstructing the complex terminology and classification systems that often serve as hurdles for newcomers. By mastering these foundational concepts, you will move beyond rote memorization and start to see the logical architecture that governs the entire insurance industry. We are going to build a mental map that clarifies the roles of the insurer, insured, owner, applicant, and beneficiary with absolute clarity. Each of these actors occupies a specific place in the contract, and confusing them is the most common reason for failure in the national exam. We will also tackle the fundamental operating principles of risk management, specifically focusing on insurable interest and the principle of indemnity. You must grasp why the law mandates that the applicant suffers a financial loss upon the death of the insured. Without this requirement, insurance would simply be a form of gambling, which is exactly what regulators spend their time preventing. We will look at how mortality tables function as the mathematical bedrock for all premium calculations, ensuring you understand the underlying mechanics of risk pooling. Understanding how actuarial science interacts with legal requirements is essential for answering those tricky questions about policy pricing models. The curriculum is structured around the three core pillars of coverage: term, whole, and universal life policies. I have designed this course to avoid the typical confusion between these structures by using comparative analysis rather than simple lists of facts. We will look at how cash value accumulates, how premium schedules shift, and the specific mechanisms that trigger death benefit payouts. By comparing these structures side by side, the distinguishing characteristics become obvious rather than vague. You will learn the exact constraints and permissions associated with each type, which is the only way to tackle the scenario-based questions you will face on screen. A significant portion of our time will be spent on the legal nature of insurance contracts, as these concepts underpin almost every statutory requirement. We will dissect the characteristics of adhesion, aleatory, and unilateral contracts to explain why courts and regulators view these documents the way they do. An insurance contract is not like a standard buyer-seller agreement. It is a promise of future performance based on contingent events. Recognizing why these legal definitions exist will provide you with the necessary context to navigate questions about policy riders and non-forfeiture options. These are not just regulatory hurdles, but are the actual safeguards that define the policyholder's rights. By the end of this journey, you will possess a structured mental model that allows you to decompose any test question into its constituent parts. We will focus on high-frequency topics, such as the dichotomy between participating and non-participating policies, to ensure you do not lose easy points. This course requires focused study, but it rewards you with the ability to identify the correct answer almost instantly, even when the phrasing is designed to be ambiguous. I look forward to guiding you through this material as we simplify the complex, ensuring you are fully prepared for the exam. I will see you in the next lesson. Welcome back. In this chapter, we will break down the mechanics of term insurance, starting with the most straightforward variety, level term. Level term insurance functions on a simple, unambiguous premise. When you purchase this type of policy, the face amount remains constant throughout the entire specified duration, which we call the term. If you secure a policy with a $500,000 death benefit, that value stays fixed whether you pass away in the first year or the final month of the contract. This provides a measurable level of security, as the beneficiary knows exactly what amount will be paid out upon the death of the insured. Because the benefit amount does not fluctuate, it serves as a reliable tool for covering specific debts or financial liabilities that also remain static over time. You are essentially paying for a pure transfer of risk from yourself to the insurance carrier for a finite period. Unlike other complex structures, there is no interplay between the death benefit and an internal investment component. This lack of complexity makes the product easier to evaluate and cheaper to underwrite compared to permanent alternatives. The premium structure of level term is designed for predictable budgeting. While the mortality risk theoretically increases as the insured person ages, the insurer averages these costs over the duration of the term. You typically receive a guaranteed level premium for the chosen initial term, such as 10, 20, or 30 years. During this period, your monthly or annual payment never increases, regardless of changes in your health or the prevailing market interest rates. This is fundamentally different from annual renewable term insurance, where the premiums typically adjust upward each year to reflect your attained age. By choosing a level premium structure, you are front-loading some of the costs, paying more than the actuarial cost of protection in the early years to offset the higher costs in the later stages of the term. This stability is the primary reason individuals choose these policies for long-term planning. We must recognize that level term insurance exists solely to provide death protection. It does not contain an equity accumulation engine, meaning there is no cash value buildup within the policy. When you reach the expiration date of your term, the coverage ceases completely, and the insurer keeps all premiums paid up to that point. If the insured outlives the policy duration, no benefit is paid, and the contract simply terminates. This makes the product a pure expense, similar to how car insurance functions, rather than an asset that you can borrow against or surrender for a cash value. Because there is no savings element, the entire premium dollar is focused on funding the death benefit and the administrative costs of the policy. This clarity of purpose is what allows the policy to remain highly cost-effective for the average consumer. These policies are primarily used for temporal financial needs that have a clear endpoint. A common example is mortgage protection, where the homeowner wants to ensure their family can pay off the balance of a fixed-rate loan if the primary earner dies prematurely. Another frequent use case is child education funding during the dependency years. The coverage is intended to remain in effect only until the children are financially independent. In these scenarios, the insured is managing risk that is limited in time, rendering permanent, more expensive coverage unnecessary. By aligning the term length with the duration of the liability, you effectively manage costs while maintaining sufficient protection. Once the mortgage is paid or the children graduate, the need for the death benefit typically evaporates, making the expiration of the term policy a logical conclusion to the financial strategy. Underwriting is the mechanism that determines your eligibility and your specific rating class for level term insurance. Because the insurer is guaranteeing a level premium for a long duration, they are sensitive to the current health and age of the applicant. During the application process, the insurer will evaluate your medical history, current health markers, and lifestyle factors to categorize you into a specific rating class. Those who are healthier and younger generally secure lower, more favorable premium rates because they represent a lower statistical probability of filing a claim during the term. Once the policy is issued, the rating class is locked in, and the insurer cannot change the premium based on health developments occurring after the policy is in effect. This initial underwriting rigor ensures that the insurance carrier can sustain the guaranteed level premium commitments made to their policyholders. We will move on to our next topic now. Welcome back. We are now turning our attention to specialized term insurance structures that deviate from the standard level death benefit. Decreasing term insurance is fundamentally a mechanism designed to map onto a liability that diminishes over time, most commonly a residential mortgage or a commercial loan. Imagine you borrow a significant sum from a bank to purchase a property, with a repayment schedule that steadily reduces the principal balance over 30 years. A decreasing term policy follows this trajectory precisely, where the death benefit starts at the face amount equal to the initial debt and declines annually according to a predefined schedule. Crucially, the premiums remain level throughout the entire duration of the policy, despite the fact that the insurer's exposure to risk is essentially being eroded as the benefit drops. This creates a specific financial alignment where the coverage exactly matches the remaining debt balance, ensuring that beneficiaries are not left with outstanding obligations upon the death of the policyholder. From an underwriting perspective, the insurer calculates the premium based on the average risk exposure over the term, which allows for a cost-effective solution compared to a level term policy that provides a constant benefit amount. It is not an investment vehicle, and it holds no cash value at any point during its life, meaning that if the insured person survives the term, the policy expires with zero remaining benefit. The logic is strictly utilitarian, aimed at debt liquidation rather than long-term estate planning or wealth transfer. On the opposite end of the spectrum lies increasing term insurance, which is rarely sold as a standalone policy, but almost always as a rider attached to a base policy. This structure is intended to address the shifting requirements of the policyholder, specifically regarding inflationary pressures or an increasing need for protection as a family grows. You might see this integrated as a cost of living adjustment, where the death benefit increases by a fixed percentage or in line with the consumer price index, ensuring the purchasing power of the benefit remains stable despite economic volatility. Another frequent application is the return of premium benefit, which effectively behaves as an increasing term supplement because it pays out the sum of all premiums paid to date in addition to the base death benefit. Unlike decreasing term, where the primary driver is the amortization of a debt, increasing term is a deliberate instrument for growth, designed to bolster coverage when income or financial responsibilities scale upward. The premiums for an increasing term rider will typically rise as the coverage expands, reflecting the heightened risk exposure the insurer undertakes as the potential payout increases. For your exam purposes, it is essential to distinguish between the static nature of a fixed debt liability and the dynamic, upward movement of inflation-protected coverage. When analyzing these products, the math revolves around a relationship between the insurer's liability and the premium structure. In a decreasing term scenario, the risk is front-loaded. The insurer assumes the highest potential payout in the early years when the debt is highest, and this risk decreases as the amortization schedule progresses. This allows the insurer to maintain a steady, lower premium compared to a permanent product that would provide a level benefit for the same duration. Conversely, with increasing term, the insurer is betting that the insured may not utilize the full extent of the coverage as it grows, yet the pricing must account for the increasing probability of a significantly larger payout. You must be able to categorize these based on their application. Decreasing term is for satisfying a specific declining debt, while increasing term is for meeting future escalating financial needs. Understanding these nuances helps in selecting the appropriate risk hedging tool for the policyholder, which is a frequent theme in standard examinations. Keep these mechanical distinctions separate in your mind to ensure you can identify the correct policy type based on the description of the financial need. See you in the next session. Welcome back. We are turning our attention to the specific contractual features that allow a policyholder to maintain coverage regardless of changes in their health. When we analyze term life insurance, the primary drawback is that the protection is limited to a specific period, after which the coverage typically expires. To mitigate the risk of being uninsurable at the end of that term, insurers offer the guaranteed renewability provision. This feature grants the policyholder the contractual right to extend the term of coverage for another period without requiring any new medical evidence of insurability. It is critical to understand that while the coverage continues, the premium is not locked in at the original rate. Instead, the insurer calculates the new premium based on the policyholder's attained age at the time of renewal. Even though the cost increases, The benefit of this provision is that it creates a safety net against the potential development of chronic health conditions. Without this guarantee, if your health declined during the initial term, an insurer could legally deny a new application, leaving you without protection when it matters most. While renewability keeps the current term structure intact, the convertibility feature offers a different kind of flexibility by allowing the exchange of term insurance for a permanent form of coverage. This conversion privilege permits a policyholder to transition to a whole life policy without the need for medical underwriting, regardless of their current health status. This is not merely a policy extension, but a fundamental shift in the nature of the insurance contract, moving from temporary protection to a permanent asset that builds cash value. Because you're effectively bypassing the medical exam, insurers impose specific deadlines for this transition. These conversion windows are often defined by a date, such as before the policy reaches a certain age or remaining term, and failing to act before this deadline results in the permanent loss of the conversion right. Understanding these time constraints is essential for any practitioner because once the window closes, the policyholder is left with only the standard renewal options at potentially much higher rates. When a policyholder exercises the right to convert, the premium structure undergoes a significant change that reflects the switch from term to permanent insurance. In most cases, the insurer offers the policyholder two primary ways to calculate the new premium based on their age. The first method uses the insured's attained age, which results in a premium based on how old they are at the moment of conversion. The second, less common, method is the original age approach, which backdates the premium rate to when the original term policy was first issued, typically requiring a lump sum payment of the difference in premiums plus interest. Regardless of the method, the permanent policy will carry a higher annual premium than the expiring term policy because it is designed to last for the duration of the insured's life and includes an investment or cash value component. For the insured, this upgrade represents a strategic choice to lock in permanent coverage rather than repeatedly facing the increasing premiums of a renewable term policy. We must distinguish between the right to renew and the right to convert because they serve entirely different long-term objectives. Renewability is triggered simply by the expiration of the term, acting as a functional bridge to allow continued temporary protection at current market rates for your age. Conversion, by contrast, is a strategic trigger that allows the insured to shift their financial planning from pure death benefit protection to long-term wealth accumulation and permanent security. If a client faces a decline in health, the conversion option becomes incredibly valuable, as it might be their only path to securing permanent coverage that they would otherwise be ineligible to buy on the open market. Exam scenarios often test your ability to recognize when an insured needs to exercise these rights to avoid coverage gaps or loss of insurability. By mastering these provisions, you demonstrate a practical understanding of how to protect a client's insurance portfolio against the inevitable risks of aging and health fluctuations. I will see you in our next session. Welcome back. Today we examined the mechanics and financial implications of return of premium term insurance, a specific product structure that blends traditional term protection with a potential refund. Return of premium, or ROP. Term life insurance functions as a standard term policy with an added endorsement that guarantees a refund of all, or occasionally a significant portion, of the paid premiums if the insured survives the policy term. At face value, this appeals to many consumers because it eliminates the perceived waste of paying for insurance that never pays out a death benefit. However, from a structural perspective, these policies are priced significantly higher than standard, level term alternatives. The insurance company must account for the time value of money and the high probability that they will indeed have to pay back the full premium amount at the maturity of the term. Essentially, you are paying an additional premium increment that the insurer invests over the duration of the term to accumulate the capital necessary for the future refund. Unlike a savings account, you only receive this capital back if you outlive the defined policy period. When analyzing the tax status of these refunds, it is important to understand that the IRS generally views the return premiums as a return of cost basis. Because the premiums were paid with after-tax dollars, the return of those same dollars is typically considered non-taxable income for the policyholder. This creates a psychological incentive for long-term retention, as policyholders often feel compelled to keep the policy in force to ensure they do not walk away empty-handed after years of above-average payments. The trade-off is clear when comparing the higher monthly outlays of an ROP policy against the cheaper, standard level term equivalent. If a consumer simply invested the difference between a standard term premium and an ROP premium into a conventional tax-advantaged account, they might achieve a higher net return by the time the term expires. Therefore, one should view ROP primarily as a forced savings mechanism rather than a traditional market-based investment vehicle. It is vital to distinguish ROP structures from permanent, cash value insurance products like whole life. While both may provide some form of financial return, whole life policies are designed to build equity and provide coverage that lasts until death, rather than for a fixed number of years. An ROP policy remains a limited duration contract that will expire at the end of the term, leaving the insured without coverage unless they convert the policy. If the policy is terminated prior to the full term completion, the policyholder may receive a portion of the premiums back as a surrender value, provided they have met the duration requirements specified in the contract. These surrender values are calculated based on strict actuarial tables that account for the insurer's liability and the unearned portion of the premium investment. Calculating these values involves complex equations that discount the future expected refund back to its present value, often penalizing the policyholder heavily for early surrenders. See you in the next lecture. Welcome back. Today we examine the inherent limitations of term life insurance to better understand where this product fits within a comprehensive financial strategy. Term insurance serves as a pure risk transfer mechanism, providing a death benefit for a specified period without incorporating any mechanism for cash value accumulation. Because the contract function is strictly limited to indemnifying a financial loss upon the death of the insured, there is an absolute absence of living benefits or equity buildup. Once the designated term expires, the insurance company retains every dollar paid in premiums, resulting in a complete forfeiture of investment if the policyholder survives the term. This creates a binary outcome where the utility of the product is strictly confined to the duration of the policy window. While this provides the lowest possible entry cost for protection, it essentially functions as a pure expense rather than a financial asset that you might reclaim or leverage later in life. Understanding this lack of long-term utility is essential when advising clients who may eventually require more than simple temporary coverage. Many financial planners advocate for the strategy of buying term insurance and investing the difference in external vehicles. Yet this philosophy carries significant behavioral risks. Relying on this approach assumes the policyholder possesses the discipline to consistently invest the savings difference over decades while managing the underlying investment risk of those external accounts. In contrast, permanent insurance offers inherent structural stability by combining protection with a guaranteed savings component that is shielded from market volatility in many policy types. When we rely solely on term insurance for long-term needs, we expose the policyholder to the potential for coverage gaps or insurmountable costs later in life. The stability of permanent insurance ensures that the death benefit is eventually payable, assuming the policy remains in force, whereas term insurance is designed explicitly to address temporary financial liabilities rather than permanent ones like estate liquidity. The most striking limitation of term insurance is the cliff effect observed as contracts approach their expiration or renewal phases. As an insured person ages, the mortality risk increases, and the cost of renewable term premiums escalates exponentially to reflect this statistical reality. Eventually, a point is reached where the policy becomes prohibitively expensive or, more commonly, the insurance company deems the risk uninsurable, leading to the termination of all coverage. This creates a dangerous void for individuals who reach their later years only to find they lack the protection they initially sought to provide. While this is acceptable for a 30-year mortgage, it is fundamentally inadequate for objectives like lifelong estate planning or final expense coverage that extend beyond a fixed time horizon. Relying on a product that is guaranteed to vanish at some point requires a secondary, more stable plan to be implemented before the cliff is reached. In professional practice, we find that term insurance is insufficient for sophisticated financial needs that require permanence, such as providing liquidity for estate taxes or funding ongoing legacy goals. Estate planning typically requires a death benefit that is guaranteed to remain active regardless of when the individual passes away, or at least for a significantly extended duration. Conversely, using term insurance to address these permanent deficits often leads to a failure in the client's overall objectives because the coverage will likely cease long before the actual liquidity need arises. We must characterize term insurance as a tool for finite risks, such as income replacement during child-rearing years or the duration of a debt obligation. By recognizing these constraints, we can prevent the misuse of term products and steer clients toward structures that offer the endurance required for their specific, long-term financial commitments. See you in the next lecture. Hello, and welcome back. In this segment, we will contrast term and permanent life insurance structures to provide a clear framework for selecting the appropriate product based on fundamental client needs. When we examine the structural differences between term and permanent insurance, we must start by acknowledging that term insurance is designed specifically for temporary needs. It functions much like renting an apartment. You pay for the coverage during a specified duration, such as 10, 20, or 30 years, and once the term expires, the coverage ceases. There is no equity or savings component involved in these contracts, meaning that each premium dollar is strictly allocated to pay for the cost of insurance and the administrative overhead of the carrier. Conversely, permanent insurance aims to provide coverage for the entire life of the insured, typically up to age 100 or 121, provided that premiums are paid according to the policy contract. This permanent structure integrates a cash value account alongside the death benefit, which serves as a long-term savings vehicle that grows over time. While the primary purpose of term insurance is pure protection against premature death, permanent insurance acts as a dual-purpose instrument that offers both protection and a structured mechanism for capital accumulation. The cost dynamics of these two paths reveal a distinct divergence when viewed across a long-term horizon. Term insurance policies initially feature lower premiums because the mathematical probability of death during a short, specified window is relatively low. However, if you choose to renew a term policy indefinitely, the premiums will eventually increase to a point where they significantly exceed the flat, level premiums of a permanent policy bought at a younger age. Permanent policies, such as whole life, level their costs by overcharging in the early years to build up the aforementioned cash value, which effectively offsets the higher mortality risk that the insurer faces as the insured grows older. This creates a situation where the insured's financial strategy must align with their duration of need, rather than merely focusing on the sticker price of the initial premium payment. If a student or client is analyzing the affordability of these products, they must reconcile the short-term cash flow advantages of term with the long-term cost stability and asset accumulation inherent in permanent insurance designs. When assessing client suitability, we must navigate the intersection of income, age, and individual financial goals. A younger individual operating on a tight budget might find term insurance to be the only viable choice for providing a large death benefit to replace lost income, despite the lack of long-term investment benefits. As that client's financial posture matures, the need for death benefit stability might shift toward permanent solutions that offer tax-advantaged cash value growth and the ability to borrow against the policy. It is crucial to remember that permanent policies provide a sense of certainty. They do not expire, and the death benefit cannot be reduced or canceled by the insurance company as long as the contract remains in good standing. This predictability makes them a common tool for estate planning and wealth transfer purposes where the death benefit is expected to be paid out regardless of when the insured passes away. By contrast, term insurance is best reserved for debts or financial obligations that have a finite end, such as a mortgage payoff period or the years during which a child is dependent on the household income. We evaluate the structural flexibility as a final, critical metric for comparison across these products. Whole life policies typically maintain fixed, guaranteed premiums and a guaranteed cash value progression, which provide a high level of certainty at the cost of limited flexibility. Other forms of permanent insurance, such as universal life, introduce the capability to adjust death benefits or premium payments according to changing life circumstances, provided the cash value remains sufficient to support the policy's costs. Term insurance generally remains rigid throughout its life cycle, offering little room to maneuver beyond the initial issuance terms or specific conversion options. Understanding these mechanisms allows you to identify which policy type aligns best with the applicant's risk tolerance and their ability to commit to a multi-decade financial contract. Mastery over these comparisons is essential for success in your upcoming examination. I look forward to discussing the intricacies of whole life insurance in our next meeting. Welcome to our exploration of permanent protection strategies, where we examine the mechanics of foundational whole life products. This chapter provides a rigorous look at how permanent insurance functions over a lifetime, ensuring you can differentiate between various premium structures and cash value accumulation methods. When we talk about ordinary life, or straight whole life, as it is frequently referred to in the industry, we're discussing the most classic form of permanent protection available to a consumer. At its core, the policy is defined by a level premium structure that remains stagnant from the point of inception until the insured reaches age 100 or passes away. Because the risk of mortality increases significantly as an individual ages, the insurance company essentially overcharges in the early years to build a reserve, which then offsets the higher cost of insurance in the later years. This equilibrium ensures that the policyholder does not face the prohibitive premium spikes that would otherwise occur if the policy were priced annually based on attained age. The predictability inherent in this model is exactly why it serves as the cornerstone for many long-term financial plans. By maintaining a level premium, the insurer provides a sense of fiscal certainty that is often lacking in more complex, flexible premium products. From an examination perspective, you must recognize that this structure is specifically designed to guarantee lifetime coverage, provided the premiums are paid as agreed. The three pillars of a straight whole life policy are the level premium, the level death benefit, and the guaranteed cash value accumulation. The level death benefit means that the face amount remains constant throughout the life of the contract, offering the beneficiary a fixed sum of money regardless of when the death occurs. Meanwhile, the cash value represents the equity component of the policy, which grows according to a schedule defined at the time of purchase. It is helpful to view this as a systematic accumulation of overpaid premiums that the insurer holds in its general account. The insurance company assumes the entirety of the investment risk, meaning the policyholder is shielded from market volatility. Because the insurer is responsible for fulfilling these contractual guarantees, they apply a fixed, conservative interest rate to the cash value growth. This stands in stark contrast to products where the policyholder accepts investment risk in exchange for potential market-linked returns. The general account serves as the treasury for these guarantees, holding the assets in bonds and other stable instruments that ensure the solvency promised to the policyholder. A critical concept for your exam is the maturity of the policy at age 100, which is the point at which the cash value is mathematically designed to equal the face amount. If an insured individual is still alive at this specific point in time, the internal mathematics of the contract reach their conclusion, and the policy is considered matured. The insurer then typically pays out the face amount to the policyholder, effectively treating the insurance as a completed savings goal. While mortality tables have been updated in modern practice to extend beyond this age, the principle remains a vital theoretical benchmark for understanding reserve requirements. This steady, predictable growth of equity is a hallmark of the product and distinguishes it from temporary term insurance, which provides no equity or savings component. By prioritizing the permanence of coverage over flexibility, the policy provides a stable shield against the long-term financial risks associated with premature death. This predictability is why analysts often categorize such policies as conservative financial instruments rather than wealth creation engines. When considering premium affordability, straight whole life is often viewed as the most accessible entry point for middle-income applicants seeking permanent coverage. Because the premium is spread out over the entire theoretical lifespan of the insured, the annual requirement is significantly lower than that of a single premium policy or a short-duration limited payment plan. A limited payment policy requires the policyholder to cram all of their premium obligations into a window of 10, 15, or 20 years, resulting in much higher annual costs for the same amount of face coverage. For a middle-income individual on a budget, the straight life model provides the full measure of permanent protection without demanding a massive outlay of capital during their peak earning years. It is essentially a trade-off where the policyholder sacrifices the ability to truncate their premium payments in exchange for the lowest possible annual cash flow requirement for permanent life insurance. Understanding this distinction is essential, as the choice between these payment structures often hinges entirely on the policyholder's ability to commit to a lifetime payment schedule versus a desire to clear financial liabilities early. I will see you in our next session. Welcome back. We are now transitioning into the nuances of structured payment timelines within permanent insurance products. When we discuss limited payment whole life insurance, we are essentially looking at a design that compresses the total premium obligation into a shorter, predefined period. Unlike a straight life policy where premiums are paid continuously until death or until the policyholder reaches age 100, these plans focus on offloading the payment burden within a specific time frame. Common examples include a 10-pay or 20-pay policy, or even a life paid up at 65 structure. The coverage remains in force for the lifetime of the insured, regardless of when the payment cycle concludes. Because the insurer must collect the same actuarial premium total in a shorter window, the individual premium payments are significantly higher than those of a standard policy. This trade-off is often acceptable for individuals desiring to finish their financial obligations before entering retirement. Single premium whole life represents the most extreme compression of this premium schedule. In this scenario, the policyholder makes one massive upfront payment that completely funds the policy for its entire duration. By doing so, the policy builds immediate cash value from day one, which can be seen as an aggressive accumulation strategy. Because the funding is front-loaded, the interest growth often exceeds that of policies with long-term payment schedules. However, this immediate capitalization triggers regulatory oversight regarding the tax-favored status of life insurance. When you fund a policy too quickly, it ceases to be viewed primarily as a death benefit and begins to look more like an investment vehicle in the eyes of the tax authorities. This shift in classification is where we encounter the modified endowment contract, or MEC, status. To prevent individuals from using life insurance purely as a tax-advantaged savings account, the federal government implemented the 7-pay test. If the cumulative premiums paid during the first 7 years of a policy exceed the net level premiums that would have been required to pay up the policy in 7 years, the contract is reclassified as a MEC. Once a policy is designated as a MEC, it loses certain tax benefits, specifically regarding withdrawals. Any withdrawals or policy loans are then subject to LIFO, last in, first out, accounting, meaning you're deemed to be pulling out the earnings first, which are taxed as ordinary income. Furthermore, you may face a 10% penalty on withdrawals taken before the age of 59 and a half. For high-earning clients, the mathematical advantage of these structured payment plans centers on the velocity of cash value growth. By paying more early on, a greater portion of the premium is allocated to the policy's reserve, which in turn benefits from compound interest over a longer period. While the upfront costs are undeniably higher, the total cost of the policy is often lower than a lifetime pay policy because the insurer carries less long-term credit risk and the cash value compounds more effectively. It is a strategic pivot that requires careful tax planning, primarily because of the MEC thresholds I just mentioned. As an advisor, you must ensure that your client's desire for rapid cash value accumulation does not inadvertently convert their insurance plan into a taxable asset. Despite the payment period ending, the death benefit provides permanent coverage up to the maturity age of the policy, which is typically age 100. This is a common point of confusion for students. The cessation of premiums does not mean the cessation of coverage. Once the 10-pay policy is fully paid, the insurance remains in force and the mortality coverage stays constant. The policy continues to operate, often accumulating dividends if it is a participating policy, even though no further cash outflows are required from the policyholder. This provides a clear, documented endpoint for the client's financial liability while maintaining their insurance protection. Balancing these needs, liquidity, tax status, and lifetime coverage is the essence of mastering these variations. I will see you in the next segment. Welcome to the chapter on adjustable life insurance, where we will examine how this hybrid product offers policy owners the ability to adapt their coverage over time. By the end of this section, you will understand the mechanics of shifting premiums and face amounts to align with your changing financial reality. Adjustable life is effectively the chameleon of the insurance world, blending features of both term and whole life insurance into a single contract. When you purchase this policy, you are not locked into a rigid structure, as the design explicitly allows the policy owner to modify three primary variables. You can alter the face amount of the death benefit, adjust the amount of premium paid, and even change the length of the period of protection. This flexibility is meant to anticipate life's unpredictability, such as a sudden salary increase or the growth of a family, without needing to cancel your existing policy and start a new one. It is a singular, integrated contract that evolves rather than requiring a complete replacement when your circumstances shift. However, these modifications are governed by an internal balance that you must respect to ensure the policy remains in force. If you decide to increase your death benefit, the insurance company will almost certainly require proof of insurability. This is because the company is taking on more risk, and they need to confirm that you or the insured individual still meets their medical underwriting standards. Conversely, lowering the death benefit or increasing the premium payment often allows for structural changes without additional medical exams. Every variable is interconnected, meaning that if you choose to shorten the protection period to pay off the policy faster, the required premium might decrease, even if the face amount stays constant. The capacity to transition from term-like characteristics to whole life-like characteristics is what makes this product uniquely versatile. If you're in a stage of your life where funds are limited, you might adjust the policy to act like a term product, focusing primarily on high death benefit protection. As your income stabilizes, you can shift the policy toward whole life characteristics by increasing the premium to build cash value or solidify long-term coverage. This transition allows the policy to serve as a bridge between temporary financial obligations and permanent legacy goals. You are essentially managing the policy parameters to reflect your current risk profile rather than settling for a product that was designed for a static life phase. While the flexibility is an obvious advantage, one must be aware of the administrative complexity inherent in managing such a dynamic contract. Each time a change is requested, the insurer must perform calculations to ensure the policy remains sustainable under the new parameters. This administrative overhead is something that both the insurer and the policy owner must acknowledge because it differentiates these policies from traditional set it and forget it products. You are essentially acting as a manager of your own financial instrument, which requires a proactive approach to ensure that adjustments are executed correctly. Failing to monitor these changes can lead to unintended consequences, such as a lapse in coverage if you miscalculate the premium required for a specific death benefit level. This policy type is particularly well suited for individuals with fluctuating incomes or those experiencing significant changes in their family structure. Someone starting a business, for instance, might need a high death benefit today but lacks the cash flow to sustain a premium for a traditional whole life policy. As their business grows, they can increase their contributions, effectively moving those dollars into cash value accumulation. Alternatively, a young professional who anticipates a significant increase in lifestyle expenses might want the ability to dial back their insurance commitments later. By choosing an adjustable product, you avoid the cost and inconvenience of purchasing multiple products as you age or your financial health improves. For exam purposes, you must focus on the extent of the owner's control over these policy parameters and the specific limitations imposed by the insurer. Remember that while premium flexibility is a hallmark of this product, it is not an invitation to ignore the underlying cost of insurance. When the insurer asks about the limitations on adjustments, they're probing your understanding of the relationship between underwriting and risk. As you age, your health profile changes, which limits your ability to increase coverage without fresh scrutiny from the insurance company. Keeping these boundaries in mind will help you parse through the scenarios presented on the exam, as examiners often test your ability to distinguish between policy types that allow changes versus those locked in at inception. I will see you in the next lecture. Welcome back. In this lesson, we explore the mechanics of cash values and living benefits, which define the structural utility of permanent life insurance. Permanent life insurance distinguishes itself from term coverage primarily through the accumulation of cash value. While the face amount represents the death benefit payable upon the insured's demise, the cash value is an internal account balance that builds over time due to the premium structure. When you pay a premium on a whole life policy, a portion covers the cost of insurance and administrative fees, while the remainder is directed toward a reserve account. This reserve, guided by actuarial assumptions, grows systematically. It is critical to understand that this cash value is not an asset that belongs to the insurer alone, but an equity buildup that the policyholder can access under specific conditions. Unlike a savings account, however, this growth is tax-deferred, meaning you do not pay income tax on the interest or gains as they accrue within the policy. This deferred status creates a powerful incentive for long-term holding, as the internal equity compounds without the annual friction of tax reporting requirements. Accessing this capital is typically facilitated through policy loans or partial withdrawals. When a policyholder takes a loan, they are essentially borrowing against their own cash value, using the policy itself as collateral. The insurance company charges interest on this loan, but the policyholder's cash value often continues to earn interest, albeit at a potentially different rate. If the loan remains unpaid at the time of death, the outstanding balance, including accrued interest, is deducted from the death benefit before it is paid to the beneficiaries. This is why policy loans are not taxable as income. They're technically a debt obligation rather than a distribution of assets. However, should you choose to make a partial withdrawal, the tax treatment shifts toward the first in, first out, or FIFO method. Under this framework, you are essentially withdrawing your cost basis first, which is typically not taxable, and only once that basis is exhausted does the withdrawal become subject to ordinary income tax. If a policyholder decides to stop premium payments, they're still entitled to their accrued cash value through non-forfeiture options. These provisions prevent the policyholder from losing the equity they have built up simply because they can no longer maintain the premium schedule. The most common option is the cash surrender value, where the company pays out the equity and the policy terminates. Alternatively, the extended term option uses the existing cash value as a single premium to purchase a term policy with the same face amount as the original, lasting for a duration determined by the amount of cash available. A third choice is the reduced paid-up option, which uses the cash value as a single premium to purchase a permanent policy with a lower face amount, requiring no further premium payments. These mechanisms ensure that the policyholder's previous financial commitments are preserved in some form rather than being forfeited to the insurance carrier. Understanding these mechanics is essential for exam success, particularly regarding how living benefits function as a bridge between protection and financial liquidity. Whether through dividends in participating policies or the strategic use of loans, these instruments provide a unique capability to supplement retirement income or provide an emergency pool of capital. While insurance companies are legally mandated to offer these non-forfeiture options after a specific period of premium payment, they vary significantly across different permanent products. For instance, universal life structures may expose cash value to interest rate fluctuations, whereas traditional whole life offers a more guaranteed, albeit conservative, growth path. By mastering the distinction between the death benefit and the internal cash accumulation, you can effectively explain how permanent insurance functions as a complex financial instrument. The core concept remains that these living benefits are inherent to the policy, contingent on the specific product design and the legal requirements governing the contract. I will see you in the next lecture. Welcome back. In this lesson, we will explore the critical distinction between participating and non-participating policies and how their structure impacts your client's financial outcomes. To understand the difference between these two vehicles, one must first look at the ownership structure of the insurance companies themselves. Mutual insurance companies are owned by the policyholders, and when these companies perform better than their actuarial projections, perhaps through lower mortality rates or better investment returns, they distribute a portion of this surplus back to the policy owners. This distribution is technically called a participating policy, which means the policyholder participates in the company's favorable experience. Contrast this with stock insurance companies, which are owned by shareholders, not policyholders. Because these companies exist to generate a return on equity for their investors, they typically issue non-participating policies. In a non-participating policy, the costs are fixed and guaranteed, meaning you pay exactly what is agreed upon in the contract regardless of how well or poorly the company performs. The insurer assumes all the risk of adverse experience, and in exchange, the policyholder gives up the potential to receive a share of the surplus. This results in a static, predictable cost structure that appeals to those who prioritize certainty over the possibility of a dividend return. It is vital to clarify what exactly an insurance dividend is, as many people mistakenly conflate it with investment dividends from a brokerage account. An insurance dividend is essentially a return of excess premium that the company collected from the policyholder during the year. Because the IRS views this as a return of capital rather than a distribution of profit, it is generally not taxable. The only time a dividend becomes taxable is if the total dividends received exceed the cumulative premiums paid into the policy, which is known as the cost basis. Conceptually, you should view it as the company saying they charge you more than was strictly necessary to cover the death benefit and expenses, and they are now refunding that overpayment. Unlike corporate stocks, where dividends represent a share of business earnings, life insurance dividends are a reflection of an actuarial calculation that turned out to be more conservative than reality required. Therefore, the conservative nature of insurance accounting ensures that these refunds are reliable, though never legally guaranteed. Once a dividend is declared, the policyholder has several specific options for how to utilize those funds based on their personal financial objectives. The most straightforward approach is to receive the dividend as cash, which provides immediate liquidity to the policyholder. Alternatively, one can choose to leave the dividends with the insurer to accumulate at interest where the interest earned on those dividends is taxable, even though the original dividend payment itself is not. Another popular choice is to apply the dividend toward a premium reduction, effectively lowering the out-of-pocket cost for the coming year. A more strategic use of dividends involves buying paid-up additions, which are small, single premium increments of whole life insurance. These additions increase the overall death benefit and add to the cash value of the base policy. Finally, some policies allow for the use of dividends to purchase a one-year term rider, providing an extra burst of coverage for a short period without increasing the permanent face amount. When we examine the paid-up additions option more closely, it stands out as a powerful default because it enhances both the death benefit and the cash value accumulation over time. Many insurance carriers will default to this option if the policyholder does not make a specific election because it organically grows the policy's total utility. Each time a dividend is used to buy these additions, the new coverage is purchased at net rates, meaning the policyholder is essentially using pre-tax funds to acquire more death benefit without proving medical insurability. This is a significant advantage for long-term planning, especially in inflationary environments where the real value of the original death benefit might erode. By letting these additions compound, the policyholder builds an increasing foundation of coverage that is entirely backed by the company's surplus. It transforms a static insurance contract into a dynamic asset that evolves alongside the policyholder's changing needs, provided the underlying policy remains in force. The decision between a participating and non-participating policy essentially boils down to a trade-off between guaranteed stability and potential growth. A non-participating, stock-issued policy is akin to a fixed income instrument where the premiums are set in stone and the insurer internalizes all fluctuations. You're paying for a contract where you know exactly what the cost will be for the duration of the policy, which can be advantageous in rigid budgeting scenarios. Conversely, the participating policy is a more flexible instrument where the cost of insurance can effectively decrease over time through the application of dividends. However, it requires a higher initial premium and carries the uncertainty of whether dividends will be declared at all. Successful financial advising requires that you identify which of these two archetypes aligns with the client's risk tolerance and long-term objectives regarding their coverage. Choosing correctly ensures the client is not just buying a policy, but a financial product that serves their specific lifetime goals. See you in the next lecture. Welcome to our discussion on endowment and specialized life insurance policies. In this lecture, we will define these unique structures and examine when they are appropriate for client planning. Endowment policies are essentially structured as a fusion of protection and forced savings, designed to endow or pay out the face amount at a specific time. If the insured survives until the maturity date, usually defined as a specific age like 65 or a set duration like 20 years, the policy owner receives the full face value. If the insured passes away before this date, the death benefit is paid to the beneficiary just as it would be with standard whole life insurance. Because the policy must reach full maturity much faster than a traditional whole life contract, which theoretically endures until age 100 or 121, the premium costs are significantly higher. This rapid accumulation of cash value is a mathematical necessity to ensure that the policy reserves equal the face amount by the target maturity date. Consequently, while these products were once popular, they have largely fallen out of favor in the United States due to tax law changes. Under current Internal Revenue Code standards, most modern endowment contracts fail the 7-pay test, meaning they do not meet the definition of life insurance and are taxed less favorably than traditional permanent products. Beyond standard endowments, the industry offers specialized policies designed for specific familial or business needs, such as family maintenance and family income plans. A family income policy combines permanent insurance with decreasing term insurance. If the insured dies, the beneficiary receives a monthly income for the remainder of a predetermined period, followed by the lump sum death benefit. Conversely, A family maintenance policy pairs permanent coverage with level term insurance, providing a monthly benefit for a fixed set of years regardless of when the death occurs during that primary term. Choosing between these depends on whether the client wants a fixed period of income support or a decreasing support structure as children age or mortgages shrink. These policies illustrate how life insurance acts as a flexible tool for cash flow management during a beneficiary's transition period after a loss. By understanding these mechanics, you can better match a policy's structure to the specific financial dependencies of the household or the business. We must also distinguish between joint life and survivorship policies, often called second-to-die policies, as they serve distinct purposes in estate planning. A joint life policy typically pays out upon the death of the first insured, which is useful for business partners who need to buy out a deceased co-owner's share to keep the company solvent. A survivorship policy, however, only pays the death benefit when the second insured passes away, making it an ideal vehicle for covering estate taxes. When a high net worth couple holds significant assets, many of which may be illiquid like real estate or private equity, they often face a liquidity crisis at the point of the second death. These second-to-die policies offer a cost-effective way to provide the necessary cash for taxes without forcing the liquidation of core family assets. Determining whether to recommend these specialized structures requires an analysis of the total estate value and the specific liquidity requirements of the heirs or partners involved. Always ensure the client understands that specialized policies prioritize specific goals, often sacrificing the broad, flexible coverage that a general-purpose permanent policy might provide. I will see you in the next lecture. Welcome to this examination of the universal life structure, where we will focus specifically on the mechanics regarding premium flexibility. By mastering these concepts, you will gain a precise understanding of how this product separates insurance costs from investment growth. Universal life insurance is essentially an unbundled product, distinguishing it significantly from the rigid structures of traditional whole life insurance. In an unbundled policy, the components representing the insurance protection and the cash value account are identified separately for the policy owner. You should think of this as a modular architecture where the mortality charges, administrative fees, and interest credits are all visible to the consumer. Because the internal parts are transparent, the insurer provides annual reports detailing exactly how these costs impact the cash balance. This high level of transparency is a frequent topic in state insurance examinations, as it differentiates universal life from products that hide their internal expenses within a single, opaque premium structure. The hallmark of universal life is the flexibility afforded to the policy owner regarding premium payments, which is enabled by the underlying cash account. Unlike a traditional fixed premium policy, the owner is not strictly required to pay a set amount on a specific date to prevent the policy from lapsing. Instead, the insurer deducts the monthly cost of insurance and administrative charges directly from the cash value accumulated within the account. As long as the cash value remains sufficient to cover these identified monthly deductions, the policy remains force, even if the policy owner chooses to skip a premium payment or pay a reduced amount. It is important to remember that this flexibility creates a dependency on the cash account health, meaning that if the cash value is depleted by excessive withdrawals or poor interest crediting, the owner must pay additional premiums to avoid a lapse. Within the universal life framework, you must be able to distinguish between Option A and Option B death benefit structures, which dictate how the cash value interacts with the face amount. Option A, often called the level death benefit, maintains a static face amount throughout the life of the policy. As the cash value increases over time, the net amount at risk, which is the portion of the death benefit the insurer must actually pay out of its own funds, decreases proportionally. In contrast, Option B, the increasing death benefit, represents the face amount plus the current cash value at the time of death. While Option B provides a larger total payout as the policy matures, It requires higher mortality charges because the insurer's net amount at risk remains constant rather than decreasing. Market conditions play an essential role in universal life because the interest rates credited to the cash account are not locked in for the life of the contract. The insurer declares a current interest rate periodically, which may be higher than the guaranteed minimum interest rate specified in the policy contract. This fluctuation means that the policy performance is directly tethered to the economic environment and the performance of the insurance company's general account. Because these interest credits directly influence how much cash is available to pay the aforementioned monthly mortality and administrative charges, they are the primary driver of policy sustainability. When you encounter exam questions regarding this topic, keep your focus on this inherent link between market-driven interest rates and the policy owner's ability to maintain the death benefit without paying additional out-of-pocket premiums. I look forward to our next discussion on index-linked universal products. Welcome back. Today, we are exploring the technical mechanics of indexed universal life, commonly referred to as IUL. Indexed universal life insurance represents a functional evolution of the standard universal life platform by introducing a unique interest crediting methodology. Unlike a traditional fixed universal life policy that credits interest based on a non-guaranteed rate declared by the insurer, the IUL links a portion of the policy's cash value growth to the performance of a specific equity index. The most common benchmark used is the S&P 500, though insurers may offer multiple indices to provide diversification within the crediting strategy. It is essential to recognize that the policyholder does not actually invest directly in the stock market or own shares of the underlying companies. Instead, the insurance company uses the index performance purely as a mathematical formula to determine the amount of interest credited to the policy's cash value account. This structure provides a distinct risk-reward profile, aiming to capture equity market upside while simultaneously shielding the account from direct participation in market downturns. The primary protection mechanism in an IUL policy is the floor, which acts as a contractual safeguard against negative index performance. If the chosen index experiences a significant decline, such as a 10% drop over the policy year, the floor ensures that the policyholder is credited with a 0% return rather than a loss. This zero floor guarantee is the cornerstone of the IUL product, as it prevents the erosion of the policy's cash value due to market volatility. Conversely, the insurance company imposes a cap on the maximum annual gains the policy can realize during any given period. If the index experiences a 20% gain, but the policy cap is set at 10%, the policyholder only receives the 10% credit. This fundamental relationship between floors and caps is what defines the utility of the product for the policyholder. Beyond the cap, the policyholder must also account for the participation rate, which is the percentage of the index's growth that the insurance company credits to the cash value. For instance, if an index rises by 10% and the participation rate is 80%, the policy would only be credited with 8%, provided that this amount remains below the established cap. Participation rates are often adjustable by the insurer at the start of each renewal period, meaning they are not necessarily guaranteed for the life of the policy. These variables act as levers that the insurance company uses to manage the cost of the derivative options required to sustain the IUL structure. Students should pay close attention to how these rates are disclosed, as they fundamentally dictate the potential growth of the policy's cash account. When we compare the IUL to other permanent structures, the distinctions in risk allocation become quite clear. A standard universal life policy operates on a fixed interest basis, offering stability but lacking the potential for higher linked returns. On the other end of the spectrum, variable life insurance places the cash value directly into subaccounts that function like mutual funds, exposing the policyholder to full investment risk and the possibility of significant loss. The IUL sits in the middle, offering a path for growth that mimics broader market movements while maintaining downside protection. This makes the IUL a technical derivative-based instrument that requires a firm grasp of the trade-offs between capped returns and safety features. Exam questions will often test whether you understand that the index performance is simply a performance metric, not an actual brokerage return. The regulatory landscape requires that these features be clearly explained in consumer disclosures to ensure that policyholders understand exactly how their crediting rates are calculated. Because of the complexity involved in indexing, there is no direct correlation between the stock market index and the specific dollar amount added to the cash value due to the interaction of the participation rate and the cap. If a candidate is answering an exam query about client expectations, they must assume that the client is looking for the stability of a floor combined with the possibility of market index gains. Failing to recognize that the insurance company holds significant discretion over these policy components can lead to inaccurate answers regarding the policy's performance forecasts. You must view an IUL as a permanent life insurance contract that leverages equity performance for credited interest, governed strictly by the contractual ceiling and the floor of zero. I will see you in the next segment. Welcome back. Today we examine the mechanics of variable life insurance and how this structure shifts the traditional burden of financial risk onto the policyholder. When we discuss variable life insurance, we are essentially moving away from the predictability of the insurer's general account. In a standard whole life policy, the insurance company pools premium payments and invests them in conservative, fixed income assets to guarantee specific cash value growth and death benefits. Variable life takes a different approach by allowing the policy owner to direct the investment of the cash value into what the industry calls a separate account. These separate accounts operate similarly to mutual funds, offering various investment options such as stocks, bonds, or money market instruments. Because the underlying assets are exposed to market volatility, the insurance company does not provide a guarantee for the cash value growth. This means your policy value is directly tied to the performance of the subaccounts you choose, which can be advantageous in a bull market, but carries significant downside potential during economic downturns. You are essentially acting as the portfolio manager for your own policy's cash value, accepting that the market, rather than the actuary, determines your final accumulation. To maintain such a policy, you are typically required to pay a fixed premium regardless of how the underlying investments perform. While the cash value fluctuates based on market performance, the insurer provides a minimum death benefit guarantee, provided that the required premiums are consistently met. This structure distinguishes variable life from other interest-sensitive products where premiums might be adjusted based on corporate investment results. It is important to emphasize that this death benefit guarantee is not an investment guarantee. Your cash value can drop to zero if investments perform poorly, even while the death benefit remains intact as long as the base premium is paid. Consequently, the policy acts as a hedge against inflation over the long term because equity-based subaccounts historically outperform fixed interest rates. However, this comes at the cost of volatility and the erosion of the principal when market conditions do not align with your selected investment objectives. The complexity of these products necessitates a dual licensing requirement for agents and brokers. Because variable life policies are technically classified as securities, an insurance producer must hold both a life insurance license from the state and a securities license, usually authorized by FINRA, such as a Series 6 or Series 7. This regulatory layering exists because the policy is an investment product subject to market risk as much as it is an insurance contract meant for death protection. Consequently, the SEC oversees the prospectus and the offering of these subaccounts, while state insurance departments oversee the contractual aspects of the insurance policy itself. This dual oversight ensures that the policyholder is provided with a rigorous disclosure of the risks associated with the separate account investments before any purchase is finalized. Understanding that these accounts mirror mutual funds in function allows you to see why the consumer, not the insurer, assumes the risk of the investment failing to meet future cash value projections. We will carry this understanding into our discussion of hybrid models in our next segment. Welcome back to our exploration of advanced life insurance structures. In this discussion, we will analyze the mechanics of the variable universal life hybrid to understand its unique position in the marketplace. Variable universal life, often abbreviated as VUL, represents a hybrid product that deliberately fuses the premium flexibility of universal life with the investment-linked performance of variable life. In a standard universal life policy, the insurer manages the cash account and provides a fixed or interest-sensitive floor, whereas in a VUL, the policyholder assumes the responsibility of directing the cash value into various investment subaccounts. These subaccounts resemble mutual funds, offering exposure to equities, bonds, or money market instruments, which means the policy's cash value is inextricably linked to market performance. Because the insurer is not providing a minimum interest guarantee on these funds, the entire investment risk resides squarely with the policy owner rather than the insurance company. This structure allows for significant upside potential during bull markets, but it also exposes the cash value to substantial volatility and the risk of depletion during market downturns. One of the most critical aspects of VUL policies is the absence of a guaranteed minimum death benefit in many, though not all, contract structures. Since the cash value is invested in a separate account, which is kept legally distinct from the general assets of the insurance company, the performance of these investments directly dictates the policy's longevity. If the investment subaccounts fail to perform, the cash value may drop too low to cover the underlying cost of insurance and administrative fees. Unlike a traditional whole life policy where the insurer guarantees the death benefit regardless of market conditions, a VUL requires the owner to actively monitor the policy to ensure it remains in force. If the cash value reaches zero, the policy can lapse, necessitating an additional premium infusion to prevent termination. This transparency is a double-edged sword. While it allows for a clear view of fees and expenses, it removes the safety net that less sophisticated products provide. Transparency in a VUL product serves as both a benefit and a potential point of confusion for the unwary consumer. These policies explicitly separate the mortality charges, administrative fees, and investment management expenses, which are deducted directly from the cash value monthly. Because the policy owner chooses the subaccounts, they must also grapple with the associated management fees, which can have an erosive effect on net performance if not carefully managed. You should view these fees not just as a cost of doing business, but as a primary factor in the mathematical projection of the policy's long-term sustainability. When comparing VUL to Indexed Universal Life, or IUL, the primary distinction lies in how the downside protection is structured. An IUL typically offers a floor, often at 0%, protecting the owner from market declines, whereas a VUL provides no such cushion because it offers direct equity exposure. Suitability assessments for these products are stringent because of the risks involved, making VULs generally appropriate only for sophisticated investors with a high risk tolerance. An individual seeking a guaranteed death benefit or a stable retirement income stream would likely find the unpredictability of a VUL incongruous with their financial goals. However, for a client who understands market dynamics and desires to leverage life insurance as a tool for potential wealth accumulation alongside high coverage, the VUL can be a potent asset. It requires a willingness to adjust premium payments as market performance dictates, and it demands periodic rebalancing of the internal investment portfolio. In a volatile economic climate, the difference between a successful VUL strategy and a lapse policy is often the degree of diligence applied to the management of these subaccounts. The policy is essentially a tandem vehicle, combining a volatile investment portfolio with an insurance contract, and therefore it should be treated with the same level of care as a brokerage account. We have covered the fundamental mechanics of how risk and investment exposure function in these hybrid products. I will see you in the next session. Welcome back to our exploration of permanent insurance structures. In this lesson, we will examine interest-sensitive whole life insurance, often referred to as current assumption whole life. Current assumption whole life is a permanent insurance product that behaves in a way that occupies the middle ground between traditional fixed whole life and the more flexible universal life framework. Like a traditional policy, it provides a guaranteed death benefit and a tax-deferred cash value accumulation component that stays with the policyholder for life. However, unlike traditional policies that dictate fixed premiums and fixed non-guaranteed interest credits, based on long-term actuarial tables, this product responds directly to the economic environment. The insurer calculates the performance of the policy's cash value based on its current investment returns, mortality costs, and administrative expenses. If the insurance company's interest earnings outperform their initial conservative estimates, the policyholder benefits from either a reduction in future premiums or a faster accumulation of cash value. This responsiveness makes the product a hybrid, offering the stability of a contractually defined death benefit with a mechanism for economic adjustment that traditional whole life policies simply do not possess. To understand the mechanics of this product, we must look at how the insurance company manages the sensitive relationship between the policy's performance and the external interest rate market. When you purchase a policy of this type, the insurer provides a minimum interest rate guarantee, ensuring that even in a poor economic cycle, your cash value will never drop below a hard floor. Beyond this floor, the interest rate credited to the policy may fluctuate periodically to reflect the insurance company's actual performance in the bond market or other fixed income securities. This creates a scenario where the policy acts as a living document, adjusting its internal math to match reality rather than relying on a static projection made decades ago. Because the company performs a periodic redetermination of its assumptions, any change in mortality experience or administrative expenses is also factored into these recurring reviews. This is fundamentally different from a standard fixed whole life policy, where the insurer assumes the full risk of interest rate fluctuations for the life of the contract, typically leading to more conservative, lower yield projections over the long term. The flexibility of this design usually manifests in two distinct options, often referred to as the low premium and the high premium designs. A low premium design uses the initial assumption that the insurance company's investments will perform exceptionally well, resulting in lower out-of-pocket costs for the policyholder at the outset. If those optimistic interest rate projections hold true, the policy stays funded and performs as expected, effectively minimizing the cash outflow for the owner. Conversely, a high premium design assumes a more conservative, lower interest rate environment, which results in a higher initial premium commitment. This conservative design offers a greater margin of safety, as the policy is less reliant on market fluctuations to maintain its cash value growth and death benefit solvency. When the actual interest rates and internal costs are reevaluated during the redetermination process, policies designed with lower premiums are inevitably more susceptible to being underfunded if market conditions fail to meet the company's initial targets. Understanding the redetermination process is fundamental to grasping why these policies are considered responsive to the economy. Periodically, the insurer reviews its current operating expenses, the actual mortality of the insured pool, and the current yield of its investment portfolio. If the insurer observes that interest rates have climbed, they may increase the interest credited to the policy, which can be applied to either reduce the cost of the coverage or increase the cash value. Alternatively, if the insurer experiences higher than anticipated mortality costs or lower investment returns, they may increase the premiums or decrease the benefit growth to keep the policy in force. This ongoing evaluation cycle ensures that the company remains solvent while providing the policyholder with a chance to leverage upswings in the broader financial climate. Unlike universal life, with a policyholder can often change the premium amount and death benefit at will. The current assumption whole life policy remains a structured contract characterized by its permanent nature, despite these periodic adjustments. When preparing for your exam, it is useful to visualize how this mechanism differentiates itself from the rigid structures of the past. Traditional whole life is defined by its predictability, where every variable is locked in at the time of issuance, leaving the insurer to manage the risk of shifting markets. Current assumption whole life shifts a portion of that economic risk to the policyholder in exchange for the potential for higher performance, echoing the philosophy behind universal life. Yet, it retains the permanent structure and simplicity of a classic whole life policy, making it an attractive middle ground for clients who want permanent protection but dislike the perceived rigidity of traditional fixed premium products. By keeping these distinctions in mind, specifically the role of interest rate cycles, the redetermination of policy costs, and the choice between premium design structures, you will have a robust framework for understanding how these products serve the modern client. I look forward to seeing you in the next lesson. Hello, welcome back. In this chapter, we will examine the specific rules governing variable products to ensure you understand how these complex instruments are regulated by both federal and state authorities. Variable insurance products occupy a unique position in the financial landscape because they function simultaneously as insurance contracts and investment vehicles. Because they feature subaccounts that invest in equity and debt securities, regulators mandate that these policies are treated as securities products under federal law. This classification triggers a suite of requirements under the Securities Act of 1933 and the Investment Company Act of 1940. Specifically, the Securities Act of 1933 mandates full transparency through the delivery of a current prospectus. This document serves as the primary disclosure instrument, requiring the issuer to outline all fees, risks, and investment objectives before any sale is finalized. If an agent fails to provide this document, they are essentially bypassing the foundational premise of informed consent in the securities market. The Investment Company Act of 1940 governs the management of the underlying portfolios within a variable life policy, ensuring that the separate accounts are managed with ethical and structural integrity. Because of this dual nature, a standard insurance license is insufficient to sell these products. You must also possess the appropriate FINRA securities registration. This usually requires passing designated examinations like the SIE and the Series 6 or Series 7, followed by registration with a licensed broker-dealer. The broker-dealer acts as the supervisory entity responsible for ensuring that all recommended policies align with the regulatory standards set forth by FINRA. This ecosystem exists to shield consumers from the inherent volatility risks that fixed insurance products do not carry. When you're operating in this space, you're acting as a registrant under the oversight of the SEC, meaning your compliance is subject to audit at any time. Marketing practices for variable products are held to a significantly higher standard of scrutiny compared to traditional whole life products. FINRA strictly reviews all sales materials to ensure they are balanced, fair, and not misleading regarding expectations of returns. One of the most critical responsibilities you will have as a licensed professional is adhering to suitability standards, which often stem from the Know Your Customer rule. You must investigate the policy owner's financial profile, risk tolerance, and time horizon before proposing a variable product. It is insufficient to simply state that a product has high commission potential. You must prove that the product fits the client's actual long-term needs. Failure to conduct this due diligence often results in regulatory sanctions that can terminate your ability to practice in the financial sector. Prohibited practices such as churning and twisting are treated with extreme severity when applied to variable policies. Churning occurs when an agent encourages the unnecessary replacement of one policy with another simply to generate a new commission for the agent. This is particularly predatory in the context of variable life insurance because the high initial charges on these contracts can decimate the cash value for the policy owner. Twisting involves using misrepresentations or incomplete comparisons to induce a policy owner to surrender an existing policy in favor of a new one. Because variable products have surrender charges and mortality and expense risk fees, the economic damage caused by these practices to the consumer is tangible and lasting. Regulatory bodies look for patterns of frequent policy replacements as a red flag during audits of your business production. Understanding these regulations is ultimately about managing the expectations and risks inherent to the consumer. When you recommend a variable product, you are essentially asking a client to accept market risk in exchange for potential growth, which requires a high level of technical proficiency to communicate properly. The regulatory framework acts as a constraint on the industry, preventing the mis-selling of complex products to demographic groups that may not be equipped to handle them. As you study these concepts, focus on the rationale behind the regulation rather than just memorizing the act or the name of the agency. When you know why a rule exists, such as the requirement for a prospectus, you develop a stronger professional intuition for client engagement. This preparation will serve you well when you are faced with practical, reality-based scenarios on your upcoming exam. See you in the next lecture. Welcome back. This chapter focuses on how disability and waiver riders provide vital safety nets that keep coverage active during periods of income loss, ensuring your clients retain their protection precisely when they need it most. The most fundamental rider in this category is the waiver of premium, which essentially acts as an insurance policy for the policyholder's ability to pay their premiums. Should the insured meet the contract's definition of total disability, the insurer steps in to cover the costs, keeping the policy in force without requiring further payment from the policyholder. A critical aspect here is the waiting period, which is almost universally set at 6 months, during which the disability must persist before the benefit begins. It is vital to understand that the contract strictly defines total disability, often requiring an inability to perform the duties of one's own occupation initially, and later, any occupation for which one is reasonably suited. Once the waiting period concludes, the company will retroactively refund any premiums paid during those initial 6 months, provided the disability criteria were met from the start. When we shift our focus to universal life policies, the terminology shifts slightly to the waiver of cost of insurance. Unlike a standard waiver of premium that covers a fixed amount, this rider pays only the monthly deductions required to keep the universal life account solvent, including the cost of mortality and administrative fees. Because universal life structures allow for flexible premiums, the rider does not necessarily cover a set dollar amount, but rather ensures the account value does not drop to zero and lapse. This distinction is a frequent point of confusion on examinations, as the core mechanism is designed to match the unique structural requirements of flexible premium products. Students should note that the underlying requirement for total disability remains consistent with traditional life policy standards. Some policies offer a disability income rider, which operates differently by providing a literal monthly stipend rather than just forgiving the premium payment. This benefit is usually calculated as a fixed percentage of the face amount of the life insurance policy, providing a stream of cash flow to help the insured manage living expenses. This functions as a hybrid tool, blending the protective nature of life insurance with the income replacement characteristics of disability insurance. It is important to remember that these payments do not reduce the ultimate death benefit if the policyholder passes away while receiving the stipend. However, just like the premium waivers, eligibility is tied strictly to the definition of total disability and follows a prescribed waiting period. The payer benefit rider occupies a specific niche, primarily appearing within juvenile life insurance contracts where a parent or guardian is the policy owner. Its purpose is to ensure that if the adult owner dies or becomes totally disabled, the policy on the child's life does not lapse due to non-payment of premiums. This provides significant peace of mind to the owner, knowing that the child's future coverage is secured regardless of their own health or survivability. The rider typically remains in effect until the child reaches a specific age, frequently 21 or 25, at which point the policy usually converts to the child's control. It serves as a classic example of how riders are engineered to solve specific risks within highly customized client scenarios. When preparing for your exam, always keep a close watch on the age limits associated with these riders, as they are not permanent features for the life of the policy. Most waiver and disability riders expire once the insured attains age 60 or 65, reflecting the point where traditional retirement age makes income replacement benefits less relevant. If the insured becomes disabled before this cutoff date, the benefits typically continue for the duration of that specific disability, even if it persists past the expiration age. Misunderstanding these age constraints is a common error, so memorize the 60 to 65 bracket as the industry standard. Mastery of these limitations will prevent you from making faulty assumptions about the longevity of the rider protection. I will see you in the next lecture. Welcome back. In this lecture, we examine accelerated death benefit options, which allow policyholders to access funds while they are still living. The primary mechanism here is the living needs rider, which fundamentally alters the standard purpose of life insurance by providing liquidity during a period of critical need. When an insured individual faces a terminal or chronic illness, the policy can advance a predetermined portion of the death benefit to cover expenses. This process is not a loan, but an acceleration of the benefit itself, meaning the insurer effectively pays out part of the sum assured early. To qualify, the insured must provide medical certification of their condition, which is typically defined by the insurer as a terminal illness with a life expectancy of 12 to 24 months. Other common triggers include qualifying for hospice care, requiring a permanent organ transplant, or being confined to a nursing home for a long-term care need. The insurer maintains the right to request periodic recertification to ensure that the medical necessity remains valid throughout the claims process. By understanding these triggers, you can accurately identify when a policyholder is entitled to initiate this acceleration under their specific contract terms. When a portion of the death benefit is accelerated, there is a direct and permanent impact on both the remaining death benefit and the policy's overall cash value. If an insured chooses to accelerate 50% of a $100,000 policy, the remaining death benefit drops to $50,000 upon their eventual passing. Furthermore, the cash value of the policy is proportionately reduced because the insurer is effectively drawing down on the assets held within the contract. It is crucial to distinguish this process from a viatical settlement, where a policyholder sells their policy to a third party for a lump sum of cash. In a viatical settlement, the original owner essentially gives up all rights and ownership to the third party, whereas an accelerated death benefit rider allows the owner to keep the policy in force. The insurer manages the acceleration internally, keeping the relationship between the company and the policyholder intact throughout the duration of the ailment. From a fiscal perspective, the Health Insurance Portability and Accountability Act, commonly known as HIPAA, provides significant tax advantages for these transactions. Under federal law, payments received through an accelerated death benefit are generally treated as tax-free, provided the recipient meets the specific definitions of being terminally or chronically ill. This status is vital because it ensures that the funds used for medical bills or end-of-life care are not diminished by income tax obligations. Unlike receiving a cash surrender value from a policy, which might involve taxable gains, the acceleration of the death benefit is treated similarly to the death benefit itself, which is typically excluded from gross income. You should be prepared to explain that this tax-free treatment is a legislative safeguard designed to prevent adding financial distress to insured individuals already navigating severe health challenges. Maintaining this distinction is essential for exam success, as it separates life insurance triggers from standard investment or surrender events found in other financial products. See you in our next session. Welcome back. Today we are going to explore the specific mechanics of the accidental death and dismemberment rider. When we analyze the accidental death benefit, often referred to as a double indemnity rider, we are looking at a specific contractual provision that augments the death benefit under narrow circumstances. The primary utility of this rider is to provide an additional payout, typically equal to the face amount of the base policy, if the insured dies as a direct result of an accident. It is important to note that this is not a standalone policy in most contexts, but an attachment that shifts the financial liability of the insurer based on the cause of death. The term double indemnity arises because the total payout becomes double the original face amount, but this only triggers when the death is classified as purely accidental. For the claim to be valid, the definition of accidental is strictly interpreted by the insurance company to exclude any contribution from illness, disease, or pre-existing health conditions. This is a crucial distinction that differentiates life insurance from accidental death insurance, as the latter requires a specific causal event that is sudden and unforeseen. You will not see this rider increasing the actual cash value of a permanent policy because the premiums paid for this coverage are allocated solely to the risk of accidental loss. The criteria for proving an accidental death usually involve a specific time element, most commonly requiring that death occurs within 90 days of the original accident. If the insured suffers an injury but survives beyond this prescribed window, the insurer will generally decline the accidental death claim, even if that injury eventually led to their passing. Furthermore, the provisions within these policies include standard exclusions designed to protect the insurer from losses that occur through high-risk behaviors or intentional acts. Deaths caused by acts of war, self-inflicted injuries like suicide, or the commission of illegal activities are almost universally excluded. While homicide might be covered in some instances, a suicide or an overdose, even if appearing accidental to a layperson, will rarely trigger the payout. Understanding these boundaries is essential for the exam because you must be able to distinguish between a standard death benefit, which covers most causes, and this rider, which is highly restrictive regarding the nature of the event. Beyond the death benefit, the accidental death and dismemberment rider introduces the concepts of the principal sum and the capital sum. The principal sum represents the full face amount of the benefit, which is paid out if the insured dies or suffers a total loss, such as the loss of both hands, both feet, or sight in both eyes. Conversely, the capital sum is usually set at 50% of the principal sum and acts as a partial benefit for lesser, yet permanent, injuries. This typically covers the loss of one hand, one foot, or the sight in one eye, providing a financial safety net for the physical impairment rather than the death of the insured. Unlike permanent life insurance, this rider is not a vehicle for savings, and it effectively expires once the insured reaches a predetermined age, often age 65 or 70. Because it is tied to an age limit, the premium is calculated based on the expectation that the risk of accidental death changes or diminishes as one ages, or that the coverage simply becomes uneconomical for the risk profile of older individuals. In practice, when you encounter questions regarding this rider, focus on whether the scenario describes a death or a specific bodily loss. If a policyholder loses one limb, you should be prepared to calculate the payout as 50% of the principal sum based on the capital sum provision. You must also ensure that the insured's age and the time frame of the injury align with the policy's written constraints before determining if a claim is payable. By keeping these rules in mind, you remove the ambiguity surrounding how these riders interact with your broader life insurance portfolio. This logic holds up consistently across different carriers, making it a reliable area of focus for your preparation. I will see you in the next lecture. Welcome back. In this lecture, we examine how riders allow you to extend the protection of a primary life insurance policy to other family members or additional individuals. When we discuss riders that add coverage for other people, we're looking at a mechanism that grafts new lives onto an existing contract. Instead of forcing a policyholder to purchase entirely separate, standalone policies for every family member. An insurer allows the addition of a spouse rider, a children's term rider, or an other insured rider to the base policy. This approach essentially creates a centralized insurance bundle anchored by the primary insured person. The technical advantage here is administrative and financial efficiency, as one primary contract manages the risk for multiple lives under a single set of premium payment structures. You should think of this as an architectural extension to an existing system rather than building a new structure from the ground up from scratch. Each rider operates under its own legal terms while remaining tethered to the original death benefit structure of the parent policy. The children's term rider is particularly prominent in the industry because it utilizes a unique pricing model that ignores the specific number of dependents covered. You pay a singular flat premium amount regardless of whether you are insuring one child or five, which makes it an incredibly cost-effective tool for families with multiple minor dependents. The coverage is typically designed as term insurance, meaning it expires when the children reach a certain age, usually between 18 and 25. Because insurance companies assess the risk for these riders based on the aggregate behavior of the group rather than individual underwriting for every specific child, they can keep costs significantly lower than separate individual policies. This is a design choice that favors simplicity and affordability for the policyholder, matching the specific needs of minor dependents who generally do not have significant financial liabilities of their own. One of the most critical legal features associated with the children's term rider is the conversion privilege triggered at adulthood. When the child reaches the maximum age allowed by the rider, the policyholder or the child effectively holds an option to convert that term protection into a permanent life insurance policy. Notably, this transition can occur without requiring the child to provide new evidence of insurability, which is a significant benefit if their health status has shifted since the initial attachment of the rider. The face amount of this new permanent policy is typically restricted to a multiple of the original rider, commonly capped at 5 times the face amount of the rider. This mechanism acts as a safety net, ensuring that these dependents do not lose their ability to secure adequate coverage just because they have outgrown the specific term rider. When you evaluate a family term combination, you're looking at a policy structure that covers the primary breadwinner, their spouse, and their children under one unified vehicle. This is essentially a consolidation strategy that reduces the complexity of managing multiple individual policies, each with its own renewal dates and billing cycles. However, as an insurance professional, you must be careful to weigh the convenience of this integration against the rigidity it imposes. If you purchase separate policies, you gain greater portability and more precise control over the specific coverage amounts for each individual. A standalone policy typically provides more robust long-term flexibility, whereas a combined family term rider might limit your options to the specific constraints mandated by the primary policy's own renewal or expiration rules. Choosing the right structure requires a careful analysis of the dependency needs versus the long-term utility of the coverage. Riders are excellent for providing supplemental protection during the child-rearing years when expenses are highest and the loss of any family member would pose a financial strain. However, you should inform your clients that these riders are rarely intended to serve as the primary cornerstone of an individual's long-term financial security. They function best as peripheral shields that offer high value for a low premium cost, covering gaps that might otherwise remain unaddressed if the policyholder only focused on their own individual death benefit. Always check the specific contract language for the age of termination, as these vary by carrier and state regulations, which will directly impact the validity of the coverage during the conversion phase. See you in our next session. Welcome back. In this lesson, we will examine how riders like guaranteed insurability and the cost of living adjustment can be used to dynamically manage insurance protection. The guaranteed insurability rider, often abbreviated as GR, serves as a safeguard for the policy owner's future insurability by granting the right to purchase additional coverage at specific intervals. Under this provision, the insurance company agrees to issue more death benefit protection regardless of any changes in the insured's health status that might otherwise make them uninsurable or increase their premium classes. These scheduled option dates typically correspond to established life milestones, such as marriage or the birth of a child, which often correlate with increased financial responsibilities. Often, the policy language stipulates that the insured must exercise these purchase options within a specific window, usually 30 to 90 days following the qualifying event or upon reaching a predetermined age milestone. If the policy owner fails to exercise the option by the specified expiration date, that specific opportunity to increase coverage is forfeited forever. It is important to remember that these riders do not increase the coverage amount automatically. They provide an option that the owner must proactively choose to execute. Because the company takes on the risk of insuring someone who may have developed health issues since the policy inception, the rider itself carries an additional cost. By understanding these mechanical boundaries, we can better appreciate how this tool prevents the risk of becoming underinsured when a client's needs change most dramatically. While the Guaranteed Insurability rider focuses on elective increases, the Cost of Living Adjustment rider, or COLA, addresses the erosion of death benefit purchasing power caused by inflation. The COLA rider automatically tracks an external economic metric, most commonly the Consumer Price Index, to adjust the death benefit upward to keep pace with rising costs. When the underlying index increases, the policy death benefit is adjusted to reflect the change, ensuring that the original intended value of the coverage remains relevant years after the policy was first issued. Naturally, this increase in the total death benefit requires a corresponding increase in the policy premium, as the insurance company is now providing a larger liability. The specific mechanics of how the premium scales with the death benefit can vary, but the fundamental intent is to alleviate the need for the owner to manually apply for new, potentially more expensive policies just to keep up with economic shifts. This provides a level of automated financial protection that is particularly advantageous for long-term planning scenarios where inflation could otherwise render a fixed death benefit insufficient. Unlike the GR, this mechanism is reactive to the economy rather than tied to the personal life events of the insured. Careful consideration should be given to whether the client has the budget to sustain increasing premiums, as the inflation-linked adjustments will continue pushing the premium cost upward over the life of the policy. Beyond these features, we often see the inclusion of the return of premium rider or the addition of a term rider to solidify a comprehensive protection strategy. A return of premium rider acts as a subfeature that guarantees a refund of the base premium paid if the insured survives the term period, effectively serving as a savings component attached to the coverage. This differs significantly from a standalone policy, as the rider is dependent on the existence of the base contract and its associated provisions. Similarly, adding a term rider to a permanent policy serves the purpose of boosting total protection during specific high-need years, such as during a mortgage payoff period or while children are still in the home. By anchoring these riders to a base permanent policy, one can craft a portfolio that provides a stable foundation while allowing for flexible growth. We are looking at a strategy that future-proofs the insurance portfolio by combining the predictability of permanent life protection with the elasticity offered by these specific targeted riders. It is rarely beneficial to view these components in isolation, as their true value emerges when they are layered to match the projected life cycle needs of the policyholder. Properly configured, these additions simplify the administrative burden of maintaining adequate coverage throughout several decades of evolving financial requirements. I will see you in the next lecture. Welcome back. Today we delve into the technical mechanics of non-forfeiture values and the structured distribution methods known as settlement options. When a policy owner stops paying premiums on a permanent life insurance policy that has accumulated cash value, that equity does not simply vanish. Non-forfeiture options protect the policy owner's right to that cash value, preventing a total loss of investment. The first option is cash surrender, where the insurer pays the accumulated cash value directly to the policy owner, minus any policy loans or outstanding interest. By choosing this route, the policy owner terminates the contract entirely and relinquishes future coverage. Understanding this is critical because it represents the total liquidation of the asset. Once a policy is surrendered for cash, it cannot be reinstated, making this a permanent decision regarding the contract status. The second path is the reduced paid-up option, which uses the existing cash value as a single premium to purchase a fully paid-up permanent policy. Because this new policy is bought with a lump sum rather than ongoing premiums, the face amount is significantly lower than the original policy. However, the protection remains in effect until age 100 or until the insured's death. This approach is ideal for individuals who want to maintain some level of permanent coverage without any further premium obligations. The insurer calculates the new, smaller death benefit based on the insured's attained age and the current cash value pool. It effectively preserves the nature of the whole life contract while eliminating the burden of future payments. The third and most common choice is the extended term option, which is often the automatic default if the policy owner fails to select another. Under this provision, the insurer uses the cash value to purchase term insurance with the same face amount as the original policy. The duration of this term coverage depends on the amount of cash value available to pay the one-time premium. Once the mathematical duration expires, the coverage ceases completely, meaning the protection is temporary rather than permanent. This mechanism allows the policy owner to maintain full death benefit protection for a limited time after they stop paying premiums. It acts as a bridge, ensuring that beneficiaries receive the intended financial support for as long as the cash value can afford the risk. Transitioning to death benefit distributions, settlement options dictate how the proceeds are paid to beneficiaries upon the death of the insured. The lump sum option is the default and provides the full death benefit in a single payment, which is generally free from federal income tax. If beneficiaries prefer a stream of income, they might choose a fixed period or fixed amount option. With a fixed period, the insurer pays out the benefit plus interest over a specified number of years, while a fixed amount option pays out a set sum until the principal and interest are exhausted. Both of these rely on actuarial calculations to ensure the total payout matches the underlying policy value and the interest earned by the insurer. Interest-only and life income options offer more specialized financial management for beneficiaries. Under the interest-only option, the insurer retains the principal and pays the beneficiary periodic interest, which is fully taxable as ordinary income. The beneficiary retains the right to withdraw the principal at any time, but upon their death, the principal passes to a designated secondary beneficiary. Life income options are designed to provide a guaranteed stream for the duration of the survivor's life. Variations include life with period certain, which guarantees payments for a specific time frame even if the beneficiary dies early, and joint and survivor, which continues payments across the lives of two individuals. These elections are generally irrevocable once payments commence, meaning beneficiaries cannot change their mind once the income stream begins. See you in the next lecture. Welcome back to our final session, where we consolidate everything we have learned to ensure you are fully prepared for your certification exam. We will synthesize the mechanics of all policy types and focus on final strategies for the test itself. When looking at the landscape of life insurance, it helps to categorize products by the permanence of the death benefit and the accumulation of cash value. Term insurance remains the simplest archetype, providing a death benefit for a specified period without any equity buildup, which is why it is strictly a risk transfer mechanism. Moving toward whole life, we see a shift where level premiums are calculated based on the insured's age at issue, allowing for a predictable cash value accumulation that follows a statutory schedule. Universal life introduces a shift in control, decoupling the premium, the cost of insurance, and the expense charges, which creates a flexible environment where the policyholder can adjust their inputs. Variable products push this complexity further by shifting the investment risk onto the owner, as the cash value is tied directly to subaccounts rather than the insurer's general account. When you evaluate these on a test, visualize the policy as an engine. Term is a simple internal combustion engine, while variable universal life is a complex hybrid system that requires constant monitoring to avoid stalling. Understanding this spectrum is essential because exam questions often test your ability to distinguish who bears the investment risk in specific policy archetypes. Beyond the product structures, we must master the immutable clauses that govern the life insurance contract. The incontestability clause generally prevents the insurer from voiding a policy after a set period, usually 2 years, even if there was a material misrepresentation during the application process. This serves as a vital consumer protection, but remember that it does not extend to cases of fraudulent impersonation or a total lack of insurable interest. We also have the suicide clause, which typically restricts death benefit payouts if the insured takes their own life within 2 years of policy issuance, limiting the payout to a refund of premiums paid. The grace period is another protective provision, granting the policyholder additional time, usually 30 or 31 days, to pay an overdue premium before the policy lapses. Additionally, when considering multiple deaths in a single event, the Uniform Simultaneous Death Act provides a default legal framework to determine the distribution of proceeds when the order of deaths cannot be proven. Always check if the policy language includes a common disaster clause, which overrides statutory default rules by requiring the beneficiary to survive the insured by a specific duration to receive the proceeds. Successfully navigating the exam requires more than just memorizing definitions. You must master the logic of multiple-choice questions. A common strategy employed by exam writers is the use of distractors, which are plausible-sounding but technically incorrect statements designed to lead you away from statutory truths. When you encounter a question about non-forfeiture options, such as reduced paid-up insurance or extended term, eliminate choices that involve the loss of all equity, as these options are specifically designed to preserve the existing value. Similarly, when assessing policy writers, remember that their primary purpose is to customize the core contract, so look for answers that address specific needs like disability income or accelerated death benefits for terminal illness. Regarding the tax treatment of proceeds, prioritize the fact that death benefits paid in a lump sum to a named beneficiary are generally income tax-free, whereas interest earned on proceeds left with the insurer is taxable. If a question feels ambiguous, look for the most conservative interpretation that aligns with the goal of the policy, as insurance regulation is inherently biased toward contract enforcement and consumer stability. As you prepare to sit for your state licensing examination, your mindset is just as critical as your technical knowledge. You have already absorbed the functional differences between term, whole, and variable products, and you understand the importance of riders in providing supplemental coverage. Before the test begins, take a moment to breathe and mentally organize your knowledge of the 3 pillars: contract provisions, insurance regulations, and premium mechanics. Do not let complex scenarios about policy loans or dividends distract you from the fundamental nature of the life insurance line of authority. Remember that state licensing boards focus on your ability to protect the insured and the public interest above all else. Focus on answering queries based on the regulatory framework rather than what you believe might happen in a real-world outlier scenario. Preparation is the bridge between uncertainty and competence, and you have built that bridge over these sessions. Stay calm. Read every word of the question carefully to spot negatives or exceptions, and trust the foundation you have laid. Carry this confidence into your examination.